But what the median investor seems to not understand is that when real wages are negative, consumption is supposed to be negatively impacted by that, but it wasn't in 2022. So basically, American consumers bridged 5-6 quarters of negative real wage growth with access to credit and by dipping into savings. Now, a whole bunch of bears on FinTwit are going to come at us and say like, oh, credit card debt is going up. That's bearish. Consumers are dipping into savings. That's bearish. No, it's not. It's not bearish at all. You could have been there in 2003 shaking your little fist about credit growth expanding in the US and shorting the market. And guess what? You'd be out of all the money you have. You'd be out of a job if you're a professional investor by 2008 when you could have had your moment when you were ranked. Well, guess what? You were wrong for 5 years.
It is now my great pleasure to introduce Marko Papic, the chief strategist at Clocktower Group, but also a great entertainer. So I really look forward to this discussion on the 2023 outlook in your company. Marko, welcome to the show.
Oh, it's such a pleasure to be speaking with you again, Andreas. Thank you for having me.
Marko, I consider you a glass half full type of guy. So why don't we start with the things that make you upbeat for 2023?
Yeah, and let me just explain something. The reason I am a glass half full guy is because it's much easier to make money off of geopolitical risk premium draining from the markets than trying to anticipate it coming into the market, And just because, it's not like I can't see risks coming up. It's just that it's difficult to time when they articulate themselves. It's very rare that a country will tell you exactly when they're going to invade another country. Although in Russia's case, maybe they did. But it's much easier to sort of short the geopolitical risk premium when, it's on the cover of The Economist, when FinTwit is blowing up, as you and I found out this year with the natural gas crisis in Europe. It's much easier to kind of anticipate it draining once it hits its own constraints. So 2023 really for me is a year when a lot of the policymakers that pursue the unsustainable preferences, when they meet their material constraints, so what do I mean by this? I think the Fed is obviously going to downshift in terms of its hikes. The market's already pricing that in. The market is a little bit too bearish. The market's pricing in a recession in terms of the Fed cutting rates. I wouldn't go that far, but I think it's clear that the Fed's preferences are now going to start hitting their constraints. I think the war in Ukraine is going to dissipate as a story on pages number 1 and 2 of global newspapers, which would be good for European assets. And finally, we already saw what happened in China. It's something that's actually a 2022 story, but Chinese policymakers also hit their constraints and had to pivot away from zero COVID, away from macroprudential oversight of the TMT sector of real estate. And so 2023, to me, actually looks pretty good for risk assets. I think that CPI will continue to drain, will come down. I think that's like manna from heaven for financial assets. I think it's also manna from heaven for the real economy. So as far as the US is concerned, I actually don't think we get a recession. I think there's more upside in US equities. And then I also think that the real opportunities in 2023 will be outside of the US, whether that has to do with emerging markets, Chinese equities, Chinese assets. Japan is probably going to be the best performing DM equity market. And then I think Europe could potentially be a really positive for investors, but we still need a little bit more clarity on the geopolitical and energy cost front.
I tend to agree with a whole lot of this assessment, Marko. So let's try and look at each of these risk themes from a risk-reward perspective. I'd like to start with the discussion on disinflation in the US. Inflation is coming down. That's pretty clear by now. The trend has been clear for, say, 3 to 6 months already. But how low can we go, and why does it matter for equities?
So yeah, and you were actually one of the first to point this out. I think one of your first missives that you wrote, and then you were kind of like, oh, I was too early. I kind of backtracked, but actually, you can go back to that first initial piece from Steno's research, right? And Steno signals. I'm just shameless plug here for your research, and I remember you can go back to it. Sometimes our initial gut, something that comes out of the gut, tends to be actually quite correct. And so now we are seeing CPI come down. So why is this important? I think it's important for three reasons. First of all, real wages are going to go up. That's very important. And I think what investors are not realizing right now, clearly the median investor is bearish on at least the economy, not equities. But what the median investor seems to not understand is that when real wages are negative, consumption is supposed to be negatively impacted by that, but it wasn't in 2022. So basically, American consumers bridged 5-6 quarters of negative real wage growth with access to credit and by dipping into savings. Now, a whole bunch of bears on FinTwit are going to come at us and say like, oh, credit card debt is going up. That's bearish. Consumers are dipping into savings. That's bearish. No, it's not. It's not bearish at all. You could have been there in 2003 shaking your little fist about credit growth expanding in the US and shorting the market. And guess what? You'd be out of all the money you have. You'd be out of a job if you're a professional investor by 2008 when you could have had your moment when you were right. Well, guess what? You were wrong for 5 years. Credit expansion and the willingness of consumers to take on credit card debt to dip into their savings means that there's no reason for them to be precautionarily saving. We're so far removed from the last cycle. And so when inflation comes down, real wages turn positive while consumers are willing to take on debt and dip into savings. Now it's supercharging what happened in 2022. So that's the first reason that I think CPI coming down is really important. The second reason, and the reason that I want to convince everyone watching this, that basically CPI coming down proves that magic exists. This is going to be like literally magic, manna from heaven, is that real wages are going to go up, but nominal wages may go down. So everybody knows that every single CEO survey is essentially telling you that CEOs are Charlie Brown depressed. They're more depressed than ever. They're on suicide watch, according to the surveys. So nominal wages are unlikely to go up. It's unlikely that like Atlanta Fed median wage tracker is going to go beyond 6%. It's probably going to downtrend to somewhere around 5, maybe even 4%. Real wages go up, nominal wages go down. What does that mean for earnings? Well, it means that earnings could actually, from a wage perspective, which is the biggest cost for most small and medium businesses in the US, profit margins may actually be flat, maybe even be positive. Wages are not going to dip into profit margins, but the consumers are going to have more money. And that's why I say CPI going down is magical. And then the final point, which is a little bit complicated, but it's this excess money argument. M2, while on the rate of change has obviously collapsed, it's still in absolutes. Deposits are at a huge level in the US. And when inflation comes down, it means prices of goods and services are coming down, which means there's more M2, there's more money available for financial assets. And I think that that's another way that CPI coming down is very positive. If you look at previous periods of bear markets, like in the 1970s, when CPI was coming down in those bear market periods, true, it was a bear market, but in periods when CPI was downtrending, equities tended to do very well.
We are recording this interview during the Davos World Economic Forum week, and everything we've heard from Switzerland this week reveals an extremely bearish sentiment among decision makers present in Switzerland. And I've said this before, but I want so badly to introduce an inverse Davos ETF, and that ETF would be positive on the world right now if we'd use that as a contrarian signal. But if we look at this inflation trend, one thing that I still find tricky to assess is whether it will be enough to prompt a change of policy stance from the Fed. What is your base case for this year when it comes to the reaction function?
This is the number one question, because when I speak to our LPs and our investors and our clients here at Clocktower Group, which a large part of them are, sovereign wealth fund, pension funds, very sophisticated investors. They say, well, hold on a second. You're bullish on the economy. You don't think US can have a recession, given your view of different components of the GDP equation. Fine. But then the Fed obviously is not going to just raise rates by 50 basis points as is currently priced by the market. There's not going to be cuts in the summer or later. They're going to hike more. And I say to that, yeah, I probably am in the camp that they could hike, I don't know, 75, 100 basis points. But the issue is this: as CPI downtrends, they can declare victory. They can continuously say, look, we're going to be in wait and see mode. And then CPI is going to settle somewhere. Now, it's not going to settle at 2 or 3%. It's going to settle 3 to 5%. Now, I understand that forecast, you can sail an aircraft carrier through it, but, I'm not going to try to model where inflation is going to settle. Maybe you can, I don't know. Let's just say it's between 3 and 5%. At that point, they've clearly missed their mandate. And so what do they do at that point? And that point is going to come sometimes between, let's say, September and November. The problem then becomes twofold. First of all, you're 12 months away from the US election. Even the great Paul Volcker hesitated with his hiking cycle once he got closer to the US election. So that's the first thing I would say. The second thing I would say is I want you and other watchers of this to find me the political constituency that's going to have a problem with 3 to 5% inflation. I want to find that mythical political constituency. Because let's go down the list. At 3 to 5% CPI, given nominal wages, real wages will be flat to positive, which means consumers are not going to be happy, but they're not going to be mad as they were at 10%. So it's a big difference. Second, we know corporates are going to be fine. Inflation is just a euphemism for price increases. And if they can get 3 to 5% CPI that consumers can withstand, given real wages and nominal wages, then corporates are going to be fine. So consumers and corporates are happy. The sovereign, obviously the United States of America, 3 to 5%. Well, it looks like we can maybe whittle down some of that sovereign debt hoard. And then finally, the savers. Savers, they must be really mad about 3 to 5% CPI. Well, first of all, in the United States of America, you really have two types of savers: those that have extraordinary amount of wealth and those that live on Social Security. But let's say there are mythical coupon clipping Americans, which I really don't think. This isn't Denmark. You know what I mean, Andreas? So even the coupon clipping, the mythical baby boomer that actually lives off of their savings account, even they are going to be fine. Why? Well, think about the last cycle. In the last cycle, inflation was 1.5%, 1.7%. Were they happy? No, because the Fed funds rate was 0. Today, if CPI comes down to 3 to 5%, let's say 4, yeah, inflation is 4%, but where's the Fed funds rate? Even the savers are actually going to be okay. No one's going to be thrilled. Everyone's going to be kind of miffed to okay. And all I'm saying is that come September, October, November, who's going to demand that the Fed raises rates aggressively? This is a political question for me. I cannot find that political constituency unless PhDs in economics get together and march in Washington and demand a calamitous recession because of some idiotic model or because of something Kiwis decided, 30 years ago.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.